When we get a huge pile of trash to contend with like this, we try to pack our skid steer bucket to the max. Probably almost looks like it's overflowing, but that way we maximize the amount of trash we can pull on each run. Know what you're thinking? Funny enough, you're right. This is exactly how you should be funding your universal life insurance policy. Great minds think alike, right? So universal life insurance policies are different than whole life or term life policies in that they build cash value while charging 1-year renewable term prices. This means on a universal life policy, you have a minimum cost you have to pay to keep the coverage. This is also known as your cost of insurance. And because that cash value can build up and be taken out tax-free, you also have a maximum amount of premium you can't go over until the IRS deems it as a normal investment. Well, some universal life insurance policies get sold on the minimum side. This means the advisor sold the policy at the smallest cost possible in order to be competitive on the price. The problem with this method is, 1, you don't build any cash value, you're only paying for the expenses to be covered. 2, your cost of insurance goes up as you age. So even though the price might start out low and competitive, over time it's going to increase. And if you don't keep up with those increases, it will lapse. And it's because that cost of insurance goes up every year that it's important that you actually overfund your universal life plan. This means paying more than the cost of insurance in the beginning years. This is all to please Granddaddy Warren Buffett, who understands that compounding interest is going to be our best friend here. All of that leftover cash will go into a cash accruing account. And if it's a good universal life policy, that will then receive an interest rate based on how the indices of the market does. And as you compound that interest over time, you can do different things with it, like take loans, withdrawals, or use it to pay the premiums on the very policy. But the most important thing is that cash value will cover you in the increases you'll see in the rising cost of insurance.